Hi everybody, welcome to another video of what's moving the markets. It's going to be a very interesting one because we've got some negative aspects going on such as inflation concerns, labor market strength, which is a good thing from the perspective of the economy, that it's a very strong labor market, which means there's less people asking for unemployment benefits. But then that reflects in the inflation concern that because the economy is still strong and the inflation is still persistent. And of course, oil prices are still going up, and we'll talk about that, which again adds in to the high inflation, which means the Federal Reserve might not be able to reduce the interest rates as much and as fast as the market would have liked to see, which is driving some ripples in the market, and we'll talk about that. But why I think this is going to be a really interesting video is because towards the end, you're going to see there is an unexpected winner coming out of this whole AI development. So because of artificial intelligence and chat GPT, there is a sector which is winning, right? But it's not what you think. It's a completely unexpected sector, and we'll talk about it towards the end. But first, let's talk about the key economic data that has come out this past week. And if you watched the video last week, we said that the Federal Reserve's chairman at the Jackson Hole Symposium, the economic symposium, said that they are finally ready to start reducing interest rates. But the market was not behaving like they believed what the Federal Reserve was saying. They didn't believe that the inflation would be going down and the interest rates would be going down because the financial stocks kept going up, right? And now the data that is coming out is showing why. So you can see that inflation doesn't seem to be cooling down as expected. And this is what I was telling you in last week's video as well, that it doesn't seem like the inflation is cooling down as much and as fast as we would like it to. Now, why is that? First of all, the labor market is still hot, which means there's a lot of jobs. And why does that cause inflation to be persistent? Because of wages, right? So if there's a lot of jobs, then companies would want to fight for good labor, which means they'll have to pay higher prices, higher wages, and that again causes costs to go up and then prices to go up, right? And how do we know that the labor market is strong? Because the number of people asking for unemployment claims, right, jobless claims, has been lower than expected. So that means there's less people unemployed than what was expected, and therefore more people are employed, which means the labor market remains strong, which could suggest that inflationary pressures could persist, which then again means that there may be a delay in the expected rate cuts by the Federal Reserve. And for those of you who might not know why exactly the interest rate going down is so important for the stock market to go up, especially growth stocks, so companies like Nvidia, which are having a huge amount of growth. So the cash flow that they will get will be a lot into the future, but we discount that cash flow to get the present value, right? And the discounting is done based on a rate which is primarily based on the interest rate. So once this rate goes down, then this present value goes up. So a lot of the growth stocks are massively impacted by the interest rate. And if interest rate will go down, the growth stocks present value will go up. But if the interest rate is not going down anytime soon, or it's not going to go down as much and as fast as we would like to see, then growth stocks will continue to take a hit, right? So there is a pressure on growth sectors, especially tech, because that is the main area where we are seeing growth, especially because of artificial intelligence. Now, what I want you to focus on is that there is an unexpected winner, and it's not a growth sector, it's not tech, but it is winning because of AI. And towards the end, I'm going to tell you what that is and how you can stay safe and still benefit from all the growth in AI. Right, but again, first let's talk more about why inflation is being persistent. So, the second sign we got this week was the Purchase Managers Index, right? So, this is from the Institute of Supply Management. And here we're seeing that the services sector is expanding even more than expected. So this again shows that the economy is very strong, right? And try to understand what is going on in the from the perspective of the Federal Reserve. So the Federal Reserve is seeing that, let's say, if this is the economy's trend growth rate, and this is how much the economy is growing very fast, too fast, and they want to slow it down so that it comes back down to the where the potential is, right? It's growing faster than its potential, which means they want to slow it down, and they want to then stop increasing the interest rates once they see that, all right, they've been able to slow it down. But still, the economy hasn't really slowed down, it's still expanding. So before they start reducing the interest rate, they want to make sure that the economy has stopped growing faster than its potential. And as soon as that happens, which means labor market cools down, the services sector stops expanding, then they can start reducing the interest rates. And until that doesn't happen, they would then maybe want to delay the interest rates because inflation is still very high, right? So again, concerns that inflation could persist, which again means that growth sectors are going to keep taking hits, and who's going to benefit? The banks are going to benefit from the higher interest rates, and which is something we have been seeing previously and will probably continue to see going into the next few days and maybe even weeks. Another source of high inflation is oil price going up. And how can we verify this? So another data point is that the oil inventories declined more than expected, which means the demand for oil is more than the supply, right? That's why your inventory is going down. Because if the supply was more, than the inventory would start piling up, right? But inventory is going down, which means the demand is more than the supply, which obviously means prices will go up, and prices have been going up, right? Pushing oil prices higher. And obviously this is related to the geopolitical risks in energy supply. It's not just the Middle East. Primarily there is a lot of disturbance happening in the northern African region, in your countries like Libya and Sudan, right, as well, in addition to your Middle Eastern region. So until all of this doesn't calm down and your energy supply comes back online to its full potential, we're probably going to continue to see higher oil prices, which again causes the inflationary pressures to be increased. Right. So what happens because of this? Your growth stocks take a hit, and stocks like Nvidia and overall tech sees selling pressure, and investors rotate out of growth stocks into sectors like energy, which benefits from the higher oil price, and banks, which benefit from the higher interest rates, right? So what should you do? Again, not investment advice, just an educational video, but based on what we have discussed so far, what you should do is avoid overexposure to tech. But this is where we're going to see who is an unexpected winner because of AI. See, try to understand. ChatGPT is a game changer, right? It is a revolutionary product. And it's not just ChatGPT. So many other developments in the AI space are happening, which are absolutely revolutionary. But what exactly happens in terms of companies who are participating in this AI space. Nvidia, of course, is providing chips which are being used, but they just sell that chip and get that sales one time. There is data centers that buy those chips, and what do they run on? They run on electricity. So what you have to understand is that one of the biggest winners in this new AI development is electricity companies. Companies like American Electric or NextEra, right? These are utility companies which provide electricity, and the demand of electricity is rising because of data centers that need a lot more electricity to power these AI chips, to power applications like ChatGPT, and furthermore, applications which are built on top of applications like ChatGPT, right? So this is a recurring revenue that is coming in to these utility companies, and they are particularly attractive because they are defensive. So it's not only data centers that are asking them to provide electricity to them. Of course, people get electricity in their homes and their offices, etc. So utilities are already considered a defensive play. Plus, add on top of that defensive play, this AI based data center electricity demand makes it such a lovely sector to be exposed to in this situation where there's geopolitical risks and there's inflation risks. So it's good to be in a defensive sector, plus benefit from that tech oriented, AI oriented growth, right? So instead of directly investing in tech stocks, avoid exposure to tech stocks, and position yourself to those utilities which are positioned to benefit from the rising electricity demand from data centers, right? So that is obviously one way to go. Another way to go is energy and financials. So if inflation will continue to be stubborn and persistent, so banks are probably a good option to have in your portfolio. And again, energy stocks because of the higher oil prices. But for me, I think utilities that are providing electricity to data centers, that's probably the best option here. Right. So, what should you keep a lookout for, for any changes in your current strategy? Right. So, just keep an eye on the inflation data, because based on the current discussion, what we are expecting is that inflation shouldn't cool down too much. Because if it does, then the Federal Reserve will definitely start reducing the interest rates a lot faster, which could completely change all of this, right? Then the financial sector will not do that well. And you might want to then reduce your exposure to financials if interest rates start coming down. But if inflation stays high, then obviously the Federal Reserve would delay their rate cut, which would be good for the financials. Also, keep an eye on geopolitical risks, because as long as those issues are there in terms of oil supply, your oil prices will remain high, and therefore you should be benefiting from the energy sector performance being supported with that higher oil price. But even if the inflation cools down and the geopolitical risks cool down, the theme of utilities benefiting from that data center electricity demand is not going anywhere. So this is probably the best option that we can focus on. Right. So the conclusion is we saw a very hot labor market not cooling down. We saw an expanding services sector expanding more than expectation. Oil prices still going up. Inventory still going down more than expectation. So with all of this, obviously energy and financials have been going up in terms of sectors. Looking ahead, you need to keep an eye on the inflation data. You need to keep an eye on the geopolitical tensions, right? And obviously you need to rotate out of energy and financial if you see that the inflation data is cooling down or the geopolitical tensions are cooling down. As always, if you found this update useful, please like, share, and subscribe. And definitely please comment so that we can engage with you in your comments and try to learn from each other. So thanks for tuning in and see you next week.